Now in our Street Time special report about the great or slim credit thaw, we talked to the Main Street banks. Here now, Jon Evans, Atlantic Central Bankers Bank CEO, and Leon Royer, American Bank of Montana President. Gentlemen, thanks very much to both of you for joining in this conversation. You're on the front lines. I know you both have been applying and working through getting TARP money, which obviously has been much slower and more cumbersome for private banks than it has for the big ones, and you haven't gotten it yet. But, John, what do you make of Steve going through and finding three interesting separate things that indicate a thaw? Do you buy it?
In fact, I'll give you a fourth.
Hey,
for the first time, I've seen a lot more interbank lending. In fact, over the past couple days, I've seen a lot more banks willing to trade in term Fed funds over 30 days. Those rates are probably around 3/4 right now. So there are a lot of banks now willing to boost yields by going a little bit further out, out to 30 days. And that's the first positive sign I've seen in a while.
Wow.
But as far as the bankers and their sentiment in the commercial and consumer marketplace, most bankers I talk to wish there was more demand. They've got the product and they're ready to lend. They just wish there was more demand.
It's funny. That fits what Jamie Dimon told me last week. There's just not the demand for the loans. What do you say, Leon, in Montana?
I say we have a 130% loan-to-deposit ratio. We have more demand than we can say grace over. So I don't see the rate cuts producing any good news for us. I see it creating disintermediation out of the bank. There's no reward for investors to deposit. There's a sharp distinction between what John does and what I do. He's a bankers bank, where he runs a great operation where his customers are banks. I run a commercial bank where my customers are people on Main Street.
Leon, can you talk a little bit about that book of business, where the demand is coming from right now? I know there's a lot of energy up in that part of the world, but I'm not sure if it's your part of the world.
Well, we're in western Montana, which is the greatest place in the world to live. So I think everyone either wants to live here, or they want to come here and visit and then not go home. The issue we have is velocity. That's something that's not discussed at all in the media, and I think is very important to this process. The reason that credit has frozen up, at least in our part of the world, is because the debt that's outstanding is not getting repaid on schedule. When debt is repaid on schedule, then you just continue to turn those dollars, and life is good. But if there's an impediment to repayment, which there is in many instances, those dollars don't come back in. The next person in line for a loan just stands and waits.
John,
and that's a big issue.
John, Leon brings up an excellent point that really affects banks when the Fed cuts rates. You have to lower your deposit rate. It makes it not profitable or not enticing to put your money in the bank. How much, when the Fed cuts rates, does it hurt, especially small banks like yourself?
Well, a 75 basis point cut, most banks, that'll take them 6 months to reprice their liability. So over the short run, Leon's right, that does have a big impact on the balance sheets of banks. The other thing to note is, the last time we were in a low rate environment, 2003, our funding costs are half of what they are now. So I think you're going to see an across-the-board reduction in both, saving rates, CD rates. We've got to get our rates down to keep the net interest margins from tanking here.
So, Leon, where do we go from here? When you think about, we're talking about the Fed put all the fire it could on the ice. What do we need from here to help things thaw? I mean, a lot of the Feds, for example, buying in the open market of mortgage-related securities, they've just barely started. When that is up and running, will it make a big difference, or are you not confident in that?
Well, I don't think that'll make a huge difference in the community banks that are actually serving their communities. We have a securities portfolio that represents about 2% of our assets. As I mentioned, we have a 130% loan-to-deposit ratio. The rate cuts are disastrous for small.
It looks like
the net interest margin. And as a result of that compression in the net interest margin, fixed costs are a higher portion of what we need to cover. So these costs, the rate reductions, are not going to be passed along to borrowers. We need a profit to stay in business.
But John's suggesting it's short-term, Leon, that over time you can reprice your liabilities and you can get that back in line.
Well, that may be the case in John's instance and in his part of the country. A great example of what's going on here is I've watched an ad for GMAC on TV where they're paying 4.25% for a one-year certificate of deposit. At the same time, the term auction facility out of the Fed cost us 42 basis points on the same day for 28 days. Well, we're competing with 4.25% for a certificate of deposit where we can get money from the Fed for 1/10 of that amount. So the deposit issue is critical for the success of the small bank.
All right, John, Leon, thank you very much. Appreciate both of you taking the time.